Good afternoon, everyone. Thank you so much for attending today's quarterly webinar. It's the second quarter 2025 quarterly market update here at Tobias Financial Advisors. Before we get going, just on the settings, you can download all the slides that we're going to cover today, and also you can ask questions in the chat, and we're going to address those towards the end of the slideshow. But we do have a lot of things to cover today, so we need to go ahead and get into it. There's a lot of slides to go over. So before we actually cover any of the agenda, just know that this is an informational only presentation. Should you have any specific questions on your particular situation, please reach out to your financial advisor. And if we are not your financial advisor, we would love to be working with you. So, but overall, this is an educational webinar only. So today's presenters, I am Chad NeSmith. I'm portfolio manager here at Tobias Financial Advisors. I've been here just about 4.5 years. I do trading and research for the firm, and I also present this quarterly webinar for clients to talk about the markets. And from time and time again, I have a special guest on, and this time it's Franklin Gay. We call him Franco. Franco, how are you doing?
Doing well. Excited to be talking about the One Big Beautiful Bill. Yeah, I'm Franco Gay, been at the firm, I guess 5 years next month. And so excited to be talking with everybody about this new bill freshly signed July 4th.
Yep, that's going to be in the back half. He's got a lot of really great information to talk about on the tax front, but a little bit about Tobias Financial Advisors. We are a fee-only financial advisor based in Plantation, Florida, South Florida. We have over $900 million in assets under management for 349 clients over. So it would like to round those up a little bit, 350 families. And we have 9 CFPs. 24 employees, and we've been in business for 45 years. So this was started in 1980 as a CPA firm, and in 1989 we were registered as an investment advisor. Before we get into the agenda today, this is a slide just focusing on what you can control. We're going to talk a lot about the markets. We're going to talk about inflation, jobs, the economy, and how we see things shaping up, and also how we're positioning the portfolio. But for your specific plan, it's really great just to stick to a plan. Find a plan you can stick to and stick to that plan. And that's what financial advisors do. That's what the planners do, is they structure your plan in a way that gives you a really high success rate to accomplish your own personal goal and the duration in which you are going to accomplish that goal. So other things you can control is diversifying broadly. We have international exposure in portfolios. We do focus on reducing expenses and turnover in the portfolios and minimizing taxes through tax loss harvesting, which we'll cover a little bit later in the slide. On the agenda for today, we are going to talk about the market performance in the second quarter of 2025, and it's been a pretty strong rally. We'll get into the numbers here on the next slide. 2025, the asset class returns that were there January through the end of June 30th. All the data here is through the end of June. And then we're going to zoom out a little bit and talk about the historical market performance and kind of how we are with consumer confidence and what we see going forward in equity markets for the rest of the year. Then we're going to talk a little bit about the economy. I'll talk about inflation and jobs and the Federal Reserve. And then Franco is going to talk about the big, beautiful bill and all of the interesting tax implications and provisions that come out of it. Really more of at a high level. He's not going to go through all 900 pages of it today. I don't know if we have the time for that. But he will highlight the things that are most impactful for our client base and everyday Americans. So it's really exciting, and it's going to be really great. But moving on, we're talking about the second quarter 2025 market performance. I mean, what we're looking at here is just all green. Remember, Liberation Day was the beginning of April, and the market had a really steep pullback. And then all of a sudden, all these tariffs were kind of pulled back and negotiated down, and that really led to a strong rally in the market from those April lows. With the U.S. stock market up 11%, developed was up 12. We can see it right here. Emerging market stocks also up 12. Global real estate up a little bit, but lagged some compared to some of the equity markets. It's a little bit more defensive and relies more on financing from interest rates, and interest rates were up a little bit, especially the longer term interest rates with some fears on government spending and inflation with how we're running deficit in the governments. So we did see a little bit of a pickup in longer term yields. But the bond market still was positive for the quarter, up 1.2%. So it annualizes a little bit over 4, maybe almost 5% for the year. So that's a really great quarter for the bond market. And then global ex-US bonds were up almost 2%. So really strong quarter. Historically speaking, we're not really going to beat the snapback from the COVID levels for the US market, up 22% in the second quarter of 2020 or '09, but it also wasn't the extreme pullback we saw in the depths of the financial crisis either. So we'll say a medium type of a pullback, and now we're basically at an all-time high right now at the stock market. So things are looking really good, and overall sentiment is relatively bullish with the market right now. Pulling back over historical performance, over the last year, US market up about 15%, really strong performance. Remember, going back 100 years, we're looking at maybe 10, 11% for US stocks. International stocks up 18%. I mean, those stocks were really depressed for a long time. There was a lot of hesitancy in owning those in portfolios. And now we're seeing some momentum, and more people are realizing, man, maybe I should include international stocks in my portfolio, or even increase that exposure in the portfolio. Global real estate up almost double digits here. I think that's a really good year for real estate. And the bond market up 6%. 6% for US bonds over the trailing year. I think that's a really great year. And that's June to June. So this is the last 365 days, or the last 12 months. Going back over the last 5 years, the only red blop in the screen here is the US bond market. That's coming off just such that weak 2022 when US bonds were down 13.1%. It's just going to take some time to work that off over some time. But going back over the last 20 years, you still picked up 3%. So you're tracking inflation in US bonds, even though we had within that 20 years the worst single year in US bonds in recorded history. So that's really good news. And over the last 20 years, US stock market close to its long-term average, 10.5%. Strongly ahead international developed stocks. I think there's a couple of things you can note here with this gap. The first one being is the US stock market is a little bit more exposed to technology, and international has a little bit more defensive names, or maybe a higher weighted to financials and banks. But also the US dollar is really strong over the last 20 years. And we are seeing that reverse a little bit year to date. But it's really hard to predict currency movements. And so this easily could have been flipped in many different ways. But overall, we believe in a really broadly diversified portfolio. Now we're going to get into my favorite performance chart, which breaks out a lot of asset classes. This is the asset class returns year to date, and there's a lot of green on the screen, as you can see. The highest single performing asset class is Germany, up 35% year to date. This was gold for the longest time, but it has been eclipsed, but still this is up 26% this year. But it's surrounded by.
What does that look like from a long-term asset basis? Because this is a year-over-year return.
This is 6 months. So this is okay, January to June, and gold really took off, particularly because of the deficit spending we saw in the governments, and there was a lot of fears of inflation. We saw inflation expectations explode, especially with just your regular everyday consumer and the retail investor. But gold has this tendency to do nothing for a long time. If you were to look at it over a 50-year time horizon, yes, gold's a great inflation hedge, but it goes in these periods of times where it may be flat for a long time. A really great example of that is September of 2011. All the way to COVID, gold was flat over that time period. And that's because a lot of people expected a lot of inflation coming out of the great financial crisis that did not materialize. Because we spent a lot of that money that was printed during the great financial crisis just sat on the books of banks to keep them from going under, and it didn't actually find itself into the economy. And so we don't know what's going to happen in the next 10 years, but gold's up 26%. So it'll have these time periods where it's just up really strong, and then it'll do nothing for a long time. So it's not a very reliable inflation hedge. If you are going to make this your entire inflation protected portfolio, you want to build a more diversified base that may include other asset classes there. But gold, surrounded in performance by a lot of European countries. There's France, there's United Kingdom, and even China has a great year so far this year, up 17%, 17.5%. GDP growth in China is a little bit in the high 4s right now. A lot of that's just because they had a lot of exports going into the United States that we'll talk about a little bit later. But emerging markets, really strong performance, about 15.5%. And that comes down to more and more domestic names. So the Russell 1000, that's just large cap stocks. It's basically the S&P 500, up 6%. Even with all the tariff news and all the worries about inflation, we're still positive on the year on U.S. stocks, and I think that's really great. And then credit. The steady bond exposure is up anywhere between 4 and 5%. And then the only thing that's really down or struggling this year is the Russell 2000 value and Russell 2000 growth. These are small cap companies where they would benefit from lower interest rates and the declining dollar. A lot of their revenue and a lot of their earnings are in dollars, and that hurt the performance of these stocks so far. But it could easily turn around towards the back half of the year, and there's a lot of reasons to think that. But the good news, the only good thing here that I see on the downside is crude oil. So that means if you're going to go fill up your car, it's a little bit cheaper right now than it was in January, which is great. Normally the red would be bad for consumers, but unless you own a lot of energy stocks in your portfolio, net, it's a positive for many people watching this today. Now you may be thinking, all this green, what has happened here? And how did we get to this spot? This is a chart that goes from 2025 all the way to 1980 that shows intra-year declines in the S&P 500. So the very top of that market for that year to the very bottom pullback, what is the range that we saw? And then how did it end up at the year? So for example, in this year, we saw a drop of 19% from the very top of the market to the very bottom of the market. And currently it's right around 6 or 7%, basically in the US market. This is as of July 10th. So this is a little bit different than what we saw on 6/30, but the last 2 years were relatively smooth for markets. The biggest pullback we saw in 2023 was 10%, and the market ended up 24, and then 8 and 23. So a lot of that was Mag 7 driven, and a lot of excitement around artificial intelligence, but also a lot of rebound from the rough year we had in 2022, where the markets ended up down 19%. But overall, this pullback was significant because other pullbacks that were larger ended up being recessions. So we had, 49% in the Great Financial Crisis. I mean, that was massive. And then COVID was 34, and then we had the late 80s. I think this was probably the flash crash, or what was the Black Monday, maybe. It was a 34% drawdown. And then you had the dot-com bubble. But, you may be thinking, I'm always going to get an entry spot in the market. But I mean, look how many years where you may only get an opportunity for the entire year of it being down 5 or 6 or even 3% or even 3% down in the markets. So you may or may not get a chance if you're hoarding cash to enter at a down 19 that we had this year. And so I'm really proud of a lot of our clients for holding on, because there was a lot of fear about the tariffs and the changes that were happening in the economy. And overall, I think we did a great job navigating our clients through that. So moving on to topics in focus, we'll get into a little bit of the economic side, and then Franco is going to bring us home with a lot of very interesting tax things, and we're going to be it's going to be very great. So we'll talk a little bit about the jobs. The jobs, you may be seeing that we're adding jobs and the unemployment rate is in the low 4s, but that doesn't necessarily tell the whole story of what's going on in the job market right now. And I think that this data, when you actually look underneath the hood, it gives the Federal Reserve some really good reasons to cut interest rates. So from January to June of this year, the economy has added 782,000 jobs. Going back to the trend from 2015 to 2019 before COVID, from January to June, we were going anywhere from 1 million to 1.5 million jobs. So we're even below that. Now, as of right now, over half of the jobs are in the healthcare industry. And I think this has to do with just an aging population that we have. There's low birth rates. There's more people that are needed in healthcare. Maybe we have more chronic health issues in the country. But overall, the healthcare hiring could be a secular thing that would happen in either a good or a bad economy. And that's taking up over half the jobs that have been added so far this year. Now, another sizable chunk of that is government jobs, is 17.6%. And those are mostly seasonal teachers and bus drivers that have been hired that are going to happen anyway. So when you strip out those two pieces, you can really see how weak some of the other hiring sectors are in the economy. And even though the unemployment rate hasn't picked up yet, we're not adding jobs in areas where you would if we were in a higher growth economy. And I think the Federal Reserve sees this underneath the hood. And I think this gives them a really good reason to cut, even though we're not seeing the 7-8% unemployment rate that you may see in a typical environment where the Fed would cut rates. One thing to note is going back from 2015 to 2019, healthcare as a percentage of the job growth, they were more so trending in line with how government's been so far this year, where it was anywhere from 16.4% to 18.1%. So a really big demographic shift in where our jobs are being added. Coming out of COVID, the leader was leisure and hospitality because so many of those people were laid off during COVID. You weren't going out to eat, you weren't really going out and doing the fun things, but that's really slowed down as well. And as of right now, I think that the job market is a lot slower than what it leads on in the headline numbers when you think that, oh, wow, we added so many jobs this quarter or this month or anything like that. So I think this is something I'm paying really close attention to. This and that people are not quitting their jobs at the pace that you would expect at a low unemployment rate. Now, prices, inflation, tariffs, all those things. We actually had a headline CPI, which is an inflation reading, come out this morning. It's not included here at a 2.7%. But this chart goes from 2025 all the way back to 2018. So we capture the big rise that we saw in 2022 that ended up with 9.1% inflation for that month in June of 2022. And ever since that time period, we saw just really a trend downward. And a lot of that is just stuff that is needed to work itself out, where we saw the dark blue line is shelter inflation, and that takes up about a third of all price of CPI. And that's just working itself out. And then auto insurance also working itself out because we had such a kind of a weird thing going on in the car, in the automotive sector of the economy, where the used car prices got so expensive. And I mean, I thought I would never buy a new car, but 2 years ago, I bought a new car because the used car was only 2% cheaper or something like that. So it was just crazy. But we are seeing it now in the most recent inflation reading that used car prices are going down, and that's gonna lead it to make it cheaper to rent a car and cheaper to insure cars going forward. So I think that's something that's still playing out in the economy. Frank, were you gonna say something?
Oh, yeah. I was just looking at the data and I was remembering back to 2022. Anytime you hear from the Federal Reserve, they'd use the word transitory inflation, and they talk about sticky inflation. And so, is the tariff going to cause more transitory inflation, where we'll see it kind of work itself out of the system faster, or is it sticky? What are your thoughts on that whole situation?
Yeah, Franco, that's a great question. I'm sure that's something that people are wondering. And when you go back and look at the tariffs in the previous Trump administration, it was a one-time event. And it wasn't as much as people feared. And I think that's going to be a repeat cycle of that. It's going to be a one-time increase in prices. And after that, eventually these tariffs are probably going to go away, more than likely than not. And that'll cause a tailwind for the economy. And so not only is it going to be just a one-time small event, but it's going to kind of wind up the economy for future growth, should we be able to get through it. And I do think the Federal Reserve is going to be able to guide us through this with no major headaches. I think one other thing to think about is that things that we import are goods, and we're mostly a service economy. So if we were to live in a, let's just say like Brazil or something like that, not as a developed economy, more of a goods-based economy, tariffs would affect us a lot more. But just because it's a much smaller part of our economy, it's really not going to move the needle that much on prices, as much as a lot of people may think. So, but we did get a reading out recently, and just some of the things that we're seeing higher prices on are shelter, food, home insurance. I mean, home insurance is up 1.1% just over the last month, which is pretty wild. It's up just like 4.8% over the last year. And we saw some flooding in Texas, and obviously hurricane season last year in Florida wasn't super great. And we see, I think that's something that's going to continue to happen, is the homeowners insurance market is going to be, just expect a higher bill there. We did see medical care go up just like 3.5% or so. And then we saw on the tariff side, we saw coffee go up, and things used to make windows was probably the other notable thing. But things that have gone down over the last month and year: energy, used cars, hotels actually down 3.6% over the last month. So people may not be traveling as much. TVs, which is just a trend. I mean, it feels like TV prices have been going down for years. It seems like every time I walk into a Costco, I go, man, that is such a deal on the TV. I should probably think about replacing my really old TV I have. And then, Franco, you may be excited about this, but I know you're looking for new hobbies. Sewing machines down 17%.
It's a good time to get into sewing.
Yeah, if you're looking for something, 17% reduction in the price of sewing machines and equipment. Just something of note that I saw when I was going through the table this morning on prices. So, but overall, I think the takeaway here is that inflation is not going to be as sticky or as severe as people think. We have some other things in the economy that are bringing down inflation that are going to work against the tariffs. And we're seeing it right now in longer term bond yields, where you would expect if we were to have a lasting inflation that longer term yields would be really high, but they have not been extremely high. And so that's why the market is also pricing this in. We'll talk a little bit about consumer confidence, and some people may be thinking, well, we're at an all-time high, can the market keep running? Effectively is the question I'm trying to answer here with this graph. This goes from 1971 all the way to 2025, and this lists just consumer confidence and consumer sentiment paired with the next 12 months of the S&P 500 return. So you may think that in 1972, consumers were really excited about the prospects of the economy, but the next 12 months, we were down in the market. But in 1975, they were really sad, or they were really pessimistic, and we were positive 22%. It's not necessarily a 1-for-1 ratio. Like obviously in 2004, we had a positive next 12 months. But if you were to look at all these data points, generally speaking, when the consumers aren't feeling too great, is when you have forward returns that are more exceptional than the opposite of being true. And so as of right now, we're not necessarily at the bottom of pessimism, but there is still a lot of room to run. And net investors and retail investors are pessimistic about what they see going forward. And that gives some room for the market to keep going and for people to shift more bullish over time. Now, I think that this is a really interesting graph, because this is the situation that we're in right now, where the Federal Reserve has not cut interest rates since December of 2024. And so they've had a pause where they were cutting, and then they said, well, we're just going to wait for a little bit. And then all of a sudden the new administration came in and said, hey, we're going to tariff. And so now they're waiting to see what comes out with the tariffs. And we should see some data coming in over the next 1 to 3 months, but should they resume cutting, historically speaking, going back to 1990, it's really bullish for a lot of asset classes, and a lot of asset classes do generally really well in this environment. We don't know if that's going to repeat itself over the historical perspective, but I know a lot of people have a lot of cash on the sidelines, and if rates move down, you aren't going to earn as much on that cash, and so you're incentivized to invest that money in longer term assets. Long US bonds, international stocks, historically speaking, going back to 1990, for each interest rate cut environment where the Fed paused and then resumed cutting, international stocks were up an average of 21% over the next 12 months. Large value up 22, large growth up 25, US stocks up 23. I mean, these are pretty outsized returns, more than double the historical average of the US stock market. So I think this is not, we can't predict what will happen with returns, but this is promising data that we're seeing historically speaking. And I do think that the Fed's going to cut some more towards the back half of the year.
Chad, I was curious. I saw that the Port of Los Angeles had its busiest June in its 117-year history. They talked a little bit about, suppliers wanting to get their shipments in to beat tariffs. And so, all of this whipsaw activity and rushing in supply, how does that impact inflation and the Fed's later subsequent decision to cut rates?
Yeah, we saw, especially in the GDP data, that a lot of businesses were terrified of the new tariffs, and they brought on anywhere from 1 to 3 months of extra inventory, especially sewing machines for you, Franco. They imported a lot of sewing machines in that month, and that's something that we're going to see work itself out as they get rid of this inventory, and they're going to have to import some new stuff. So that's the biggest reason that the Fed is saying, hey, let's just wait, because they saw this big tick up in inventory. They want to see a full cycle of, at the higher import price, how much of that is going to be passed along to the consumer to then be able to justify cutting rates or keeping rates the same. As of right now, the market is pricing in 2 rate cuts towards the end of the year. I'm in the ballpark of they need to do more. I think we're a lot tighter and a lot more restrictive than some of the data is actually presenting itself to be. But the market seems to think that by year end, there's like a 54% chance that we're going to have a September cut. And then by year end, there's a 7% chance that we're going to have no cuts, that it's going to be the same. And then 30 is 1 cut, so 20, only a quarter point. 42%, so that's the big median of the bell curve here, about 2 cuts. And about 20% of the market thinks it's going to be 75 basis points or more before the end of the year. I'm in the boat where I think they need to move a little bit quicker. I think they may be about 4 cuts too tight as of right now, but it's really hard to tell with the data. And we just really have to pay attention more to the higher frequency data, like weekly job claims, for example, comes out every week to try to get an idea, because some of this data is lagging. And when you think about pivots and Fed movements, you know, things can change really quickly in short-term interest rate expectations. But we should see something over the next 1 to 3 months, and it should give the Fed some good reasons to cut, should we not. Now, I don't know, this morning, I think Trump came on and he said the Fed should cut 300 basis points. I think that may be a little bit too cushy for the market, but I'm leaning towards agreeing with him to some degree that we should consider cutting, and the Fed should consider cutting a little bit more. Now, we've talked about the Fed, we've talked about the economy. We get to talk about something that's very recent and new and exciting. It's the big, beautiful bill.
Yes.
Franco.
I am excited to talk about the big, beautiful bill. So important thing here to note is that, you know, this is fresh. I mean, we're 11 days off from this being signed. And so, you know, the information that we're providing you, we have done our research and everything, but we're still likely going to need continued guidance from the Treasury, continued analysis, and all of these different things. So this is really informational in nature. Make sure you talk with your tax preparer, tax advisor before you try and implement anything based on what we've talked about today. But really, we're going to go over a lot of the notable tax provisions here. We can't go over everything. As Chad mentioned, 900 pages would be a lot of time to ask everybody to take out of their workday here. But signed into law on July 4th, 2025, really looks to expand a lot of the Tax Cut and Jobs Act provisions, but also add some new temporary provisions. So we'll get into a lot of those. This affects everybody: workers, families, seniors, businesses, and it's got, as I mentioned, some permanence to it, trying to really codify and make permanent the Tax Cut and Jobs Act provisions that were passed prior, as well as adding some temporary boosts and tax deductions to folks. So we'll jump on in here. This one, I think, is headliner everywhere, I think, because prior to this bill being passed, in the Tax Cut and Jobs Act, we had something called the state and local tax cap, which is the SALT cap, which said that folks that had more than $10,000 in property taxes or state income taxes or other kind of tangible taxes, they were capped at $10,000. And that really hurt a lot of our folks that have high state income taxes or have high property taxes, because they weren't able to itemize those and get the full deduction for those. Well, the one big beautiful bill comes in and says, hey, listen, we're going to raise this cap to $40,000 in 2025. We're going to increase that $40,000 cap each year by 1% through 2029. But take special note, this is a reversionary tax deduction. So it is going to revert back to the $10,000 in 2030, assuming nothing else happens. They've also included a phase out on this at $500,000 of modified adjusted gross income. So you can get less of this deduction if you're in those higher income, higher AGI areas. But they've mentioned that they want to keep the $10,000 as a floor. So you're still likely to be able to deduct at least your $10,000 if you are up in those high 500,000 plus modified adjusted gross income areas.
Mm-hmm. Now, Franco, we did mention modified adjusted gross income for someone who doesn't maybe do their own tax return. Like, what does that mean compared to my headline income in a tax return?
Yes. So the way it works in the tax return is your top line is your gross income, and then you've got your adjustments. And then if you take your gross income minus your adjustments, you have your adjusted gross income. Now, modified adjusted gross income is taking that adjusted gross income and adding back some items typically to it. So typically you'll be adding back your municipal bond interest, which is non-taxable. You can add back your non-taxable Social Security earnings and other things like that, certain exclusions, foreign credits and the like. to get to this modified adjusted gross income number. This number can change depending on what deduction you're looking at, but typically some kind of modified adjusted gross income is the litmus test for whether you can utilize a deduction.
Thank you, Franco. I really appreciate that. Now we're hitting the headlines early, so this next one's really interesting. It's the estate and gift tax exemption increase.
Yes, yes. So this was a big fear for folks who wanted to be able to gift or have their beneficiaries inherit property, and perhaps they were up above the estate tax exemption, which right now is 13.9 million per person. So there was a fear that when the Tax Cut and Jobs Act sunsets at the end of this year, that they would be stuck with their previous Tax Cut and Jobs Act exemption, which was 5 million adjusted for inflation. So call it 6.5, maybe $7 million per person. And so that is a big decrease. And so the one big beautiful bill comes in and says, nope, we're making this exemption permanent, and we're increasing it to $15 million per person, index for inflation in 2026. So a lot of folks who were perhaps worried about that generational wealth and whether they were going to be hit with those large 40% taxes on the passing of their estate to folks or to their beneficiaries if they were over those exemption amounts can rest a little easier now knowing that. But still, plenty of analysis needs to go into this in trying to figure out if you are going to be subject to these taxes.
Yeah, I think those are great points, Franco. And some people may be watching this going, well, I don't have 15 million. This doesn't apply to me. But if you have your investments, this is only indexed to inflation. If you look ahead 20, 25 years, you would think that maybe your portfolio might outperform inflation. So they may run into this in the future. So Franco, should they wait to do their estate planning, or should they meet with an advisor now and maybe start that process?
Yeah, you definitely don't want to wait to do your estate planning. So, if you've got $10 million today and you're not going to touch it for a long time and you're investing it and it's positive investment returns, you very well could have an exemption issue later on down the line. And so thinking about those things, talking to your advisor, no matter you have 10 million, 5 million, 100 million, you want to make sure that you speak to your folks and make sure that all your ducks are in a row so that your family doesn't have to deal with perhaps some estate tax or gift taxes down the line.
Yeah, and as a planner, I think that this is one of the areas that we add a ton of value at Tobias in the estate planning, because I mean, 40%, such a high tax rate when people pass away and have estate tax, gift tax, and there's a lot of planning that goes around this that Franco works on, and he's really great at it.
There's a lot of strategies that you can implement here to try and mitigate this, and so it's important that you talk with your folks and see if those strategies are right for you, given your retirement projection and given your goals at the end of the day. So something we definitely love to speak with anybody about.
Yep. And so next, if we're going to start a business or if we own a business, this one's great for them.
Yeah. So you've got the qualified business income deduction, the Section 199A deduction. So this was a provision that was put into the Tax Cut and Jobs Act to try and equalize corporations, C corps, with pass-through entities, partnerships, sole proprietorships, S corps. C corporations, they have a 21% tax rate, and so these pass-through entities, partnerships, S corps, sole proprietorships, they're being taxed at individual tax rates, which the Tax Cut and Jobs Act lays out at being the highest of 37%. And so they said, okay, what can we do to try and bring some kind of parity between these two entities? And so they said, let's do a 20% qualified business income deduction. And it's a very, very complex calculation, but the gist of it is that if you own a business and you have $100,000 of net income, qualified business income at the end of the day, you may be eligible for a 20% deduction on that income. So $20,000 worth of deduction if you had $100,000 worth of income, qualified business income. And that's a huge boon. So that's been made permanent within the one big beautiful bill. And the tax rates that had to go, or rather that coincided with the Tax Cut and Jobs Act, have been made permanent as well. There was a lot of fear that we would be shifting to the previous tax regimes rates and brackets, which had a top rate of 39.6%. Tax Cut and Jobs Act makes those 7 brackets within, rather the One Big Beautiful Bill makes those 7 brackets within the Tax Cut and Jobs Act permanent for us. So we know going forward, we've got that range from 10% to 37% in the personal tax brackets.
Mm-hmm. Yeah, I think this is really great, and it encourages people to start a business. So just one question for you on this. Let's say I wanted to start a food truck on the weekends as a side hustle, for example. Let's just say I make $100,000 in my W-2 income and I make $10,000 as my weekend food truck. Does this 20% apply to my whole income, or does it just apply to the food truck income?
Just your business income. Nice try though. So you'll have to not, you won't be getting a deduction on the W-2 income.
All good, all good. So here's the standard deduction. This is going to affect the highest number of people, right, Franco?
Yeah, the standard deduction increase is really important because this is what we've been dealing with for the last few years with the Tax Cut and Jobs Act. So the Tax Cut and Jobs Act effectively doubled the standard deduction of the tax tax regime that existed prior to it. And with the sunsetting of the Tax Cut and Jobs Act, we were worried, does the standard deduction go back down? Because a huge amount of people were using the standard deduction now going forward since it became so large. The One Big Beautiful Bill came in and said, hey, no, standard deduction is going to be permanent, and we're going to increase it to 15,000 for single folks in 2025, 22.5 thousand for head of household, and 30,000 for married filing jointly. And we're going to index it for inflation annually going forward. So a lot of folks will still get that large deduction. A lot of folks likely will still not be itemizing, although we probably will see a slight uptick in itemizing due to that SALT cap increase to 40,000. So it'll be interesting to see the end data once that's reported to us.
Yeah, that's great points. And it's nice to see that these are set permanently going forward. It's great for a lot of taxpayers. Makes just things really simple.
Absolutely, absolutely. And I guess a word on permanence, permanent until another tax bill comes and is introduced and is passed, right? It's so, it's not sunsetting. It's not set to change unless something else comes in and changes it. So those are kind of the big heavy hitters with regards to what is changing and what is going to affect kind of the vast majority of folks. These are some of the new deductions. These ones are a little bit less permanent. You'll see that as we go through them. One of them here is the new deduction for tip income. So this is an above the line deduction. So remember we talked about that gross income and then your adjustments and then your adjusted gross income. This goes right in between your gross income and your adjusted gross income. So it helps you get your taxable income down, or rather your gross income down. And so this allows for a deduction of up to $25,000 per taxpayer. This applies to workers in tipped occupations. So you could think of our folks in the food service, right? And it also is subject to phase outs. So at $150,000 of modified adjusted gross income, you begin to phase out of this deduction if you're single, and $300,000 if you are married. So there's some strictures in there. Qualified tip income, you need to make sure you're very specific on what that is, what your phase outs are, and then understanding that this is effective from 2025 through 2028. So this is a sunsetting provision. After 2028, we don't know what's going to happen to this provision, but it is set to go away at that time.
Yeah, and this is just for tipped occupations. So Franco, is it any possibility that your financial advisor or your CPA is going to be flipping around an iPad to you and asking for a tip at the end of a meeting or anything like that?
I don't think so. I don't think that qualifies as a tipped occupation. So no advisors will be taking tips, at least at Tobias.
That's good. That's good because there's a lot of tip fatigue out there. What's interesting is I am seeing a lot of consumers saying that they're justifying this new bill as a reason to not tip as much as they used to, saying, well, the government's given them this nice deduction. I've got tip fatigue. So it might actually end up being that these tip workers end up with less income at the end of the day if this thing overtakes the benefit of reporting and uh, and not paying federal tax on it up to this deduction. So I think it's interesting.
That is interesting.
uh, Overtime.
Yes, yes, overtime. Another deduction that's been introduced is an above the line deduction of up to 12,500 for single folks and $25,000 for joint folks. This applies to qualified overtime under the Fair Labor Standard Act. So the Fair Labor Standards Act dictates a lot of things like minimum wage, child labor laws, and what is qualified overtime. And so that is going to be the guiding light in terms of whether or not your income, your overtime income, qualifies for this. This has the same income phase outs as your tip deduction. And again, this is another one of those temporary provisions sunsetting 2028. So it does come into play for 2025, but make sure you keep an eye on those phase outs and those sunsetting provisions while you're looking and evaluating whether these more temporary provisions apply to you.
Yeah, I think the next few provisions here are some of the most interesting ones, and I think a lot of our clients are going to be really interested in this seniors deduction.
Yes, yes. So this one is really curious because right now it's being marketed a lot in the media as a deduction for folks who get Social Security income. And so I actually sat down with someone from CBS Miami and talked for a little while about this. This is much more of an age-based deduction than it is a Social Security-based deduction. So what it looks like is that taxpayers who are age 65 and older can get a $6,000 deduction. That's $6,000 per taxpayer age 65 and older, as long as you operate within these phase-out ranges. So if you're single filing, this begins to phase out at $75,000. And if you're married filing jointly, this begins to phase out at $150,000. So as I mentioned, it's intended to reduce or eliminate tax on Social Security, but as we know, there is a large band of time in which you can file for Social Security benefits. So take the example of somebody who is 62 and has decided to file early for Social Security. Well, they may be receiving Social Security benefits because they filed early, but they're not going to be eligible for this deduction because they're not age 65. So they're not getting the benefit of this. On the other end of the spectrum, there are folks who can push their Social Security filing date to age 70. Everybody can, and you get some increased benefit through your deferred retirement credits. And so what that would mean is that somebody who has decided to wait until age 70 but is age 65 is getting a deduction currently due to this, but they're not receiving Social Security. And so there are instances in which Social Security can be taken or cannot be taken, and this deduction still applies. So that's why I really like to label it more as an age-based deduction than anything else. Important to note that this is a temporary deduction as well, 2025 to 2028. This will sunset 2028.
Yeah. So what you're saying here is that the strategy around taking Social Security may have changed in your particular situation, and some planning you may have done in the past for Social Security or retirement planning may have changed, and so you should meet with your advisor, is what I'm understanding.
Yeah, I think it's an important thing to think about when you look at Social Security benefits, right? Where you previously may not have gotten this deduction. Does it make it a little bit more lucrative to take it? I don't know. We'd have to run the numbers and find out, but I think it's definitely a conversation worth having and something you should discuss with your individual advisor for your individual situation.
Yeah, and one more thing, Franco, is that people tell me that I have an old soul. So if I have an old soul, is there any chance that I could qualify for this senior deduction this year before it loses?
You know, I don't think so. I think you're out of luck on that one, Chad.
Yeah, luck there. This is the charitable deduction I'm very interested in, Franco. This one's really great.
Yeah, so the charitable donation deduction for non-itemizers, this is something that kind of harkened back to the CARES Act. During the COVID years, we saw the administration put out a tax incentive, a tax deduction for folks to give to charity, even if they weren't itemizing. I think the amount back then was something like $300. This is a little bit different. This is an above-the-line deduction, and you can deduct up to $1,000 if you're single, $2,000 if you're joint. An important thing to note is that those need to be cash donations. So as I mentioned, above the line deduction and effective January 1st, 2026. So if you know that you're not itemizing, and you know that you give cash donations, you may want to start collecting those and tallying those up, because come January 1st, 2026, this may be very applicable to you. And so want to make sure that you get every dollar that you're legally entitled to when it comes to those deductions.
Yeah, I think this is really great. I'm going to explore this next year, but this is an interesting one about interest payments on new vehicles.
Yeah, and I know we were talking, Chad, that you weren't sure on where this is going to land with regards to incentives, but deduction for interest payments on vehicles is a really interesting deduction. It's an above-the-line deduction of up to $10,000 per year for U.S. assembled vehicles. Now, pausing there on U.S. assembled vehicles, we all know that cars are very, very complex machines. And so parts of cars are assembled all over the world and brought to be assembled here in the US. And so I think that we're likely going to need guidance from Treasury and some analysts to figure out what exactly constitutes a US assembled vehicle. So interesting to understand what happens there going forward. This is really about new cars. So you can see that the loan must be originated after December 31st, 2024. So
Mhm.
this is a 2025 through 2028 vehicle that you've purchased. And there are phase outs on this, right? So if you make over $100,000 modified adjusted gross income, you begin to see that deduction go down. Same thing if you're jointly filing. $200,000 your modified adjusted gross income limit. And mentioning already that this is a temporary provision set to sunset in 2028. But I think, we all know how expensive cars are these days. We all know that interest rates are a little bit higher relative to maybe some loans we got in the past. And so this perhaps could take some of the sting out of that for folks that are landing in those phase out ranges.
Yeah, I think so. I think this is good for those people that want a new car. But I think this definitely favors the car salesman, and particularly because it's going to help them sell cars. And it seems like every video I see of them talking about their car payments, they're all paying $750 a month or $1,000 a month for their cars. So they will benefit in two ways, both as a seller and a consumer of this product.
Okay, so the Trump accounts. So this is a new tax deferred account that is being set up by the government. And there's a pilot program going on in which the government is going to seed $1,000 into the account for each child born between 2025 and 2028. So effectively, this is an account that operates kind of similar to a non-deductible IRA. Non-deductible IRA, you contribute funds to it. You don't get a tax deduction for it, but those funds grow tax deferred. Now, it looks like it's got lower limits than a non-deductible IRA at $5,000 annual contribution limit. The growth tax deferred, as I mentioned, and limited access prior to age 18. Uh, you know, from research that we've done, there is some speculation that maybe some qualified expenses for healthcare, higher education, or buying a new home, maybe starting a new business could be tax favorable, have a favorable tax distribution, but otherwise it's going to come out as ordinary income. That still needs some clarity on it. So I couldn't find really definitive answers on that one. However, I will note here that besides getting $1,000 from the government for the account, which is great, a typical 529 plan in which you contribute funds to, typically you're not going to get a tax deduction unless it's a state income tax deduction, but qualified higher education expenses that come from 529 plan are tax free. And so that is a huge boon, is a huge benefit. And as we await for more guidance on the Trump accounts, if it turns out that it is ordinary income when it comes out, or it is capital gain income treatment when it comes out, a little bit more preferential rates, that's still not as great of a deal with regards to higher education as a 529 plan. So important things to think about. But if anybody's having a baby from 2025 to 2028, make sure you get your $1,000.
Mm-hmm, mm-hmm. And speaking of 529s, there's some really new things that are going on there too, right?
Yes, yes. So we do have some enhancements that came along with the 529 plans. So you know, most parents will tell you that after school care or private school care is very, very expensive. And 529 plans previously could not be utilized for more than $10,000 a year of K through 12 payments. And so the administration has gone ahead and doubled that amount to $20,000 a year, which I think provides a lot more flexibility to parents, to folks who are paying these large bills, wanting to make sure that they can get a tax-free distribution from that 529 plan for this benefit. Another really nice thing that they've decided is that they want to expand qualified distributions to vocational credentialing and certification costs. So perhaps you have a child who went and got their undergrad degree, but didn't want to go on and get a master's degree, but wanted to get something in between, right? Maybe a certification. Chad's got the CFA, I've got the CFP. And so perhaps that's really where their heart lies. That is something that now qualifies for the 529 plan, along with credentialing and vocational. So it's important because it provides flexibility to parents, and it recognizes that degrees are not the only way to get education. There are other routes that are beneficial, that are worthwhile investing in.
Mm-hmm. I think this is a great change to the 529 account and gives a lot more option, especially as we go into a new economy with artificial intelligence and just everything changing all the time.
Absolutely, absolutely. So summary and takeaways, this is really a mix of temporary and permanent provisions. So we talked about a lot of the Tax Cut and Jobs Act things that were set to sunset that they've made permanent. And so that's really beneficial to folks. And there are a few sweeteners in there as well, right? We've got these tax deductions for folks with regards to tips, with regards to auto interest, additional 65 and older, and overtime work. And so these things are not permanent, they're temporary, but they are going to provide a bit of tax relief for folks who fall into those categories of eligible taxpayers. Really great to see that there. It does expand the savings tools that we talked about. So Trump accounts, another tax deferred account that you can utilize. We'll continue to get more guidance on what that looks like with regards to distributions and qualified distributions. Expanding the 529 plans, really, really important, especially as we enter kind of this new economy with AI, as Chad was mentioning.
Yeah.
And then, as you go through these, you want to do your research, make sure that your tax advisor, tax preparer has done their research. There are lots of phase outs, there are expiration years, and there are a lot of stipulations. Like I mentioned, this is 11 days old, and so we're really just kind of awash right now with analysis and information about it. And as the year progresses, we will understand more and more and have a much clearer picture when it comes filing time for everyone's taxes. So,
Yep, this is great. Really great information, Franco. I really appreciate it. This hammers home why I am not a CPA, because it seems like these laws are changing all the time, some for the good, some for maybe not good, but this is a really great overview. So thank you so much for your time and your research and covering all of this for us.
Absolutely, thank you.
Now we're gonna wrap it up. I got some portfolio positioning slides and then also some things to be optimistic about and things to be not so optimistic or cautious about. So portfolio positioning, given all the things that we see going on within our bond sleeve, we're keeping our short duration. So we do think the Fed is going to cut rates, and that's going to benefit shorter term bonds more so than longer term bonds. We think there may be a chance that government spending may keep longer term rates higher, so they may not benefit as much as in previous regimes with interest rate cuts. We're keeping it very high quality for now, but we are monitoring for yield spread should we want to buy some lower credit quality if we get the opportunity to do so. Given that we have had more clarity on some of the tariffs, we may get an opportunity, but we haven't done anything just yet. On the stock side, we're rebalancing where it makes sense. So international has done really well this year. I'm finding myself rebalancing from international to maybe small cap stocks that haven't performed as well. And then in April, we really were actively tax loss harvesting, but we're doing it all the time. And so you may see that you're up on the year and have a tax benefit on top of that. And that really hammers home the benefit that we have with tax loss harvesting. Additionally, with stocks, it's not listed here, but we're paying really close attention to guidance in this quarter of earnings reports, because we're gonna have a lot of companies that are gonna have a closer view on how they think tariffs are gonna affect them specifically and what the margins are gonna be and what the forward-looking earnings are gonna look like. So I think this is a really important earnings season, not for the actual earnings reports, but what companies think for the next quarter and for the next 12 months or so. I think it's very key to what's going to happen. And within our opportunistic sleeve, we're keeping our real estate and our hedged equity for now, but we're reviewing a floating rate. We do think rates are going to come down, so we may be looking for a new home for that position. That's something internally that we're talking about should interest rates move down. So things that we can be optimistic about. The Fed has very good data on to resume cutting down the road. Should things shake out as expected with the tariff news and with global trade. Global diversification is working really well this year. International, like we said, has done really, really well and has outperformed domestic stocks for this year, and it really adds diversification in the portfolio and reduces risk from year to year. Some years US stocks may do better, some years international stocks are going to do better. And so at the end of the day, owning a mix of both really hampers down volatility within your investment portfolio. Tariff caused inflation, like we covered, is not going to be a sticky event. It's going to be a one-time event that will eventually unwind down the road when these tariffs are more likely than not reduced or pulled off. And given that the Fed has good data to resume rate cutting, lower interest rates are going to help small cap stocks more likely than not, because a lot of their financing is floating rate, and it's going to make them more competitive against the larger players that have longer term fixed rate debt that they locked in during COVID. Some of these big companies have 30, 100-year debt that they've locked in at 2.5%, 3%. And so with these higher rates, these smaller companies had a hard time competing. And so we may see a reversal of that should rates fall. Some things to be cautious about. Stock valuations are lofty versus historical levels. Now, there's a little bit of caveat here, is that as of right now, we are a little bit more heavily weighted towards technology and higher growth stocks that we have in versus history, versus 20 years ago. So there's an Mag 7, so maybe they deserve a higher valuation, but overall it's still lofty versus historical measures. There's a lot of worry about the deficit spending, so continued government spending and deficit spending may cause some market concern. It may cause interest rates to rise. It's just something we're monitoring. We may see future inflation over the longer term, but we don't know how it's going to shake out just yet. As of right now, the market's not pricing that in to interest rates, but overall geopolitical conflicts, they remain. Conflicts with Russia, the Ukraine situation, the Middle East. I mean, these things just seem like they're not going to go away, but they do remain. We do see more government spending out of Europe, or more military spending out of Europe, I should say. And so I think we're going to see more individual countries kind of beef up their defense, just because they may not be as confident that the United States may defend them, even though they may be a part of NATO, for example, or they may just not sure where it's going to go, so they may just increase spending on military in the future. Inventory is increasing for home prices, so we're seeing a lot of people list their homes, but the sellers aren't really serious, it seems. They may list their home, but they're waiting for a price. They're really sticky to that price, and so we're kind of still seeing a lockstep in the housing market. I think this is going to reverse over time or work itself out over time. It's just going to take a long time to do so, but it's something that is cautious because people are having a hard time moving for jobs, or moving for maybe their family's growing, for example, or declining. We just don't know. So it's a sticky housing market, and it's something that's going to continue for a long time. So with that, I think that we had some questions. I'm looking at the chat. I don't see any questions as of right now, but otherwise we're coming up on our hour, so I don't want to take too much time. Thank you so much, everybody, for attending. Franco, thank you again for covering the tax side of it, and we really, really appreciate you taking the full hour out of your workday to talk with us about it, and we will see you at the next quarter. Thank you so much, everybody. Hope you have a wonderful day.
Take care, everyone. Bye.